What is up, everybody? How are you? Carlo here with another important video, and I believe you're going to get a lot of value from today's video. We are in tax season. It's late February here, about to be March next week of 2021, and everybody's asking questions about taxes. And these are the questions I get asked by most people, especially during this time of year. And what I've come to realize is that most people do not understand how taxes are going to affect their investments and or retirement. And so I wanted to make this video for you guys so that you get some really great education, some insight, because what I'm going to share with you, most people just don't know. I didn't know this stuff coming out. When I started in this industry back in 2004, I knew nothing about this stuff. And most people do not know. And unfortunately, most people make mistakes. I've had many people cash out 401ks and they get hit with these big tax bills. They cash out IRAs, they overfund 401ks, and they just don't know the implications of what that means long term. So I wanted to share that with you guys because if you are on the path to retirement and you want to make sure that am I saving in the right places, then this video is for you. And so I want to make sure that you guys know I am a resource for you. If you ever need any help, if you have any questions in regards to retirement, saving for retirement, life insurance, putting together a plan for yourself, of course, I want to make sure that you guys know I'm here as a resource. I can help you online. I'm going to put this video on YouTube, right? So I'll have a Calendly link. So if you want to book some time with me to get any of your questions answered, I would love to be a resource for you and help you in any which way, shape, or form in trying to accomplish your financial goals. Okay, so this video is going to be a pretty macro view. I'm not going to go in total detail, but it's going to be enough for you to be like, wow, I didn't know any of those things. Feel free to comment below, share this video because it's important information. Okay, so let's go ahead and go to my screen here. So I want to first start off by saying, or basically asking you this very, very important question. Do you believe taxes will go up or down over the course of the next 10 or 20 years? So when you look at America right now, 2021, we just went through, we're still in the midst of a pandemic, mostly more probably on the tail end of it. We had a $1.9 trillion stimulus package that's signed by President Biden, not including all the money that was pumped in by the Trump administration in 2020. What's going to happen to taxes over the course of the next 5, 10, 15, 20 years? Do you believe they're going to go up or down? Well, if you said up, I think you would not be wrong by thinking that. Now, I can't prove that. I don't know what that's going to look like next year, 5 years from now, but there's a lot of signs that are leading that way. And if you believe they're going to go up, then this is very important for you to understand. And if you're going to believe they'll go down, please comment below. I'd really like to hear your feedback on why you think they'll go down. But 99 out of 100 people will agree with me that taxes will go up. So here's the history of our tax code. And this is at just federal tax rates. We're not talking state. Now, if you look at from 1915 to 2020, this is what federal tax rates have done over the course of 105 years. Look at here in 1918, taxes which started here in 1915 at under 10%. This looks like more like 7%, 8%. Then they went up to darn near 80%. Then they go back down. Then they went back up, right? It's kind of funny. Look at here, 1945, right? It's funny when we look at the time frames here. Where was America at during these eras? We were at war, World War I, World War II, all the way through the Vietnam era. And then where we're at here, 2020, we're just shy of 40% in taxes, right? That's where we're at. Now, statistically, if you look at historically, we're at one of the lower tax rates that we've been at a federal level. What's to say that it's not going to go back up? Okay, I think it'd be foolish to think that they're going to go down based on the history and with everything going on. So why is this important? Because you need to understand, for those of you that are saving for retirement, where you're putting your money at. And that's the purpose of this video here that I want to share with you guys, because this is important for you to understand. All right, so there's only 3 areas per the tax code that you could put money at. Now, let me just make my little disclosure here. I'm not a CPA, I'm not a tax advisor, but I know enough to be dangerous here in terms of the basics. And this is all I want to get to you are the fundamentals of where you can put your money at per the tax code. You have your taxable accounts, also known as tax now. You have your tax deferred accounts, also known as tax me later. And then you have your tax advantaged accounts. I mean, right off the bat, which one already sounds better, right? If you said tax advantage, of course. But most people do not understand the differences of these. So I want to break these down, right? So if you have money in, say, CDs, money market accounts, even savings accounts that earn peanuts right now, even those little gains you make, they want to tax you on that. If you have non-qualified stocks, right, mutual funds, even crypto, which has become a big phenomenon now in 2021, and that's only going to continue to grow, they fall under the taxable category. And what does that mean? That means if you throw $100 in an account, and let's say within the year it grows to $200, well, that $100 gain, you're going to have to pay something called capital gains tax on it. So if you do it within 12 months, you're going to be taxed at ordinary income rates. If you sell your stock or investment after 12 months, you're going to be taxed at long-term capital tax rates, which are typically in the range of 15 to 20%. Okay. So in this case, Uncle Sam is your business partner because he's got 15 to 20% stake in the gains of your investments. Now, there's pros and cons to everything, right? So the pros of these types of investments is that is short term, they're liquid, you can sell quickly, get to cash quickly, right? But if that's all you have your money in, just keep in mind that you have a business partner, and his name is Uncle Sam, called the IRS, and they got 15 to 20% of your money when you sell those investments. Okay, now where most people are at is here in tax deferred or tax me later. What's the number one retirement plan in America? You guessed it, your 401k plan. Okay, you also have your traditional IRAs. If you're a business owner, you have your simple and SEP IRAs. They also fall in the same category. You have your TSPs if you work for the federal government. Okay, you have your 403Bs if you work for the state, right? Teachers, if you're a police officer, correction officer, firefighter, you have your 457s. Basically, all state, funded types of business models, right? They fall under the 403B, 457 space. You have your annuities, also pensions. They all fund under tax deferred. These are also known as qualified plans. Now, the way these work is that you have to wait until age 59 and a half to access money. If you try to pull money out and withdraw it prior to 59 and a half, you will be hit with a 10% early withdrawal penalty. Now, there are some allowances, first-time homeowner, some hardship type access, right? I know the CARES Act allowed for some access, but for the most part, most people have cashed out 401ks and they get hit with the tax bill that really surprises them. Don't do that, okay? Before you cash out a 401k or a qualified plan, make sure you talk with an advisor because it can save you a world of headache and taxes. The other thing that you need to be aware at is that if you do not start pulling out money by age 72, you're going to get hit with what we call required minimum distributions, right? So let's say, for example, that you have an investment in, say it's a 401k or an IRA, and you're like, you know what, I don't need to pull any money out of it yet, and you're 72, and the IRS says, hey, you need to pull out at least 20,000 a year from this account, and you're like, well, I'm not going to because I don't need to. And if you don't do that, they're going to hit you with the 50% penalty of what you should pull out. That would be $10,000 penalty. Yes, look it up. It's called the required minimum distributions, right? By age 72, you must start pulling money out of your qualified plan. So this is a thing where people have a lot of grievances towards qualified plans because you're at the mercy of tax law or IRS code, where you have between the ages of 59 and a half and age 72 to begin pulling money out. Not to mention the limitations, which I want to kind of scroll down here. Right, so what are the limitations? If you have an IRA, for example, and you only could put in $6,000 per year if you're under 50 years old. If you're over 50, they allow you to put an extra thousand of $7,000 per year. Now, this is for tax year 2020. I believe it's the same in 2021. If you make right over $139,000 a year and you're a single filer, you can put money in the IRA, but you don't get the tax deduction. Right. So one of the benefits of an IRA is that if you start an IRA, whatever you put in, you can deduct it from your taxes. So let's say if you make 50,000 a year and you fully fund an IRA, you're only paying taxes on 44,000 versus 50,000 because you get to deduct the $6,000. If you file jointly and you make over $206,000 with your say husband and wife, then you don't get to write it off either because you make too much money. I'll get to the Roth IRA example because it's pretty similar with Roth IRAs as well. Okay, so that's something that you need to be aware of. Also with 401ks, and that's a big part of where I want to make this video known to you guys. If your company matches you, meaning that if you put in 3% of your income and they match you up to 3%, 5%, 6%, then I highly recommend that you're doing that. Why? Because this is free money that your employer is giving you. Here is where I want to challenge this collective thinking. Right now, the current amount that you can max out in a 401k is $19,500 per tax year. If you're over 50, you can put, I believe, an additional $6,500 for a total of $26,000 a year. I have met many people since the beginning of this year that are max funding their 401k. And I get it, and I applaud them for wanting to put money away because they're very serious about retirement and they want to make sure, the stock market has been really good. I want my money to grow. I want to put as much away as I can. But here's the question. Do you believe taxes will go up or down in the next 10 or 20 years? And everybody always says up. And I said, okay, just keep in mind, you're max funding that. You're not getting a match on that extra money that you're putting in. So when you pull this money out in retirement, if your 401k, guess what you're going to be paying? Ordinary income tax. Okay. And people always question that and they provide logic and say, well, I'm going to be in a lower tax bracket, Carlo, because I'm not going to be making as much money as I was because now I'm retired. I'm not pulling out that much money from my retirements, right? And my kids are going to be moved out. My house is going to be paid off. Well, let's talk about that for a second. You lost your deduction from your mortgage because you paid off your house. You lost the deduction on your kids because they're now moved out. So you have little to no tax deductions anymore. And now you have your qualified plans that you're pulling money out. And everyone thinks, well, now that I'm older, I'm going to be in a lower tax bracket. Well, it's not called old age tax. It's called income tax. And we do not know what income taxes will be over the course of the next 10 or 20 years. So that's why I'm saying, why put all this money, right? Why do we put all this money here when we know that we're going to have to pay income taxes at an unknown rate in the future if we believe taxes are going to go up? So my recommendation is to draw your money down to the match because that's the free money. And you're going to see a difference in your net income. Now, what do you do with that extra money? This is where tax advantage comes in. And that's the purpose of this video, to give you this insight because it's very important. This is where you have your Roth accounts, okay? So what are the types of Roth accounts that you could take advantage of? Number one is the Roth 401k. If your company offers Roth 401k, you should be taking advantage of that because contrary to a Roth IRA, in a Roth 401k, you can put up to $19,500 per year, $26,000 per year if you're over 50. Now that is a phenomenal amount of tax-free money that you can be putting away because in a Roth IRA, just like a traditional IRA, you could only put $6K if you're under 50, $7K if you're over 50. And again, if you make over $139,000 per year gross income, if you're single, you don't get a Roth IRA. You make too much money. If you make over $206K per year, based on 2020 tax rules, you don't get a Roth IRA because you make too much money. So people say, well, where else could I put money, right? So there's another thing called municipal bonds. We call them muni bonds. Those are tax-free, which basically you can fund money in bonds with state or federal municipalities. I won't get into that, but those can pay you tax-free money, but the interest rates are pretty low. You're looking at maybe 3 to close to 6%, but that's tax-free. And then you have cash value life insurance. Okay, and we've all heard of this, and a lot of people don't know how cash value life insurance works. So I'm going to scroll down here. You have your whole life insurance. Okay. You have your variable universal life insurance. And then you have something that I like a lot is index universal life. Now, whole life is going to pay you that fixed interest rate between sometimes 4 and 6% in that cash value portion. VUL is going to be tied to market performance. So if the market goes up, you can make money just like any investment. But if the market crashes, you could also lose money. Now, index universal life is tied to indexes. So if the market goes up, you can make money, but if the market crashes, your money stays locked in right where it's at. So you don't lose any of your gains or your principal. And the biggest benefit of these, of why I'm talking about them, is in the tax-free portion, is that it grows tax-free, or I like to say tax deferred. So there are no growth on the taxes. And the biggest part is it's tax-free on the way out. And you're not limited like a Roth IRA. I have clients that put in $1,000 a month, $2,000 a month. I've had a client put $100,000 in one of these accounts. It's possible. It's all about how you structure them. Okay, so I'm not going to get too much into the product details of that, but if you're looking for something where could I put money if I'm not going to max fund my 401k and have that money come out tax-free? And check this out, you also don't have to wait till you're 59 and a half to access money. You can access money when you want. You can kind of use it like an emergency fund. It's multi-purpose. There's a lot of protection on it. It can grow with market performance, but never lose if the market crashes. And it's tax-free. And if you pass away, it all goes tax-free to your beneficiaries. And if you don't pass away, you get that money back tax-free in retirement. So a lot of people don't know about this side of the fence here when it comes to the tax advantage. So going back to me and wrapping up here, I wanted to share that with you guys because I want you to know that the 401k is not the end all be all, even though that's the #1 retirement plan in America. Now, if you're max funding it and you're putting as much as you can, kudos to you. But I do recommend that you look to diversify into tax-free accounts, whether you do a Roth 401k, Roth IRA, if you qualify, or you look at something like cash value life insurance. Now, we offer all three. Okay, if you're looking for some guidance there, we can meet you at almost at any level, whether you want to put away a few $100 or a few $1,000 a month, we can customize things for you. So again, feel free to book a call with me. I'm going to put my Calendly link below in the YouTube description. This is also going to go on Facebook, so feel free to comment below or shoot me a personal message and we could schedule a phone call. I could answer any questions that you have. Share this video because I believe the education is valuable. People don't know this, and I want to make sure this is the truth, guys. You can take this to the bank, do your research. It's important, right? It's important. Now, I just forgot to show you guys, so let me go back to my screen here. Just so for my Californians, because that's where I live, who question the taxes, $100,000 salary after federal and state taxes is going to net $68,332. Think about that for a second. That is currently right now in 2020. So that's what, $32,000 that's going to taxes right now. What's to say that that can't be $50,000 10 years from now or more? Think about that for a second. Again, so going back to me, you want to find a place to shelter your money from taxes, guys. It is imperative that you look at your options. Get with the trusted advisor. Get with someone that knows their stuff and see what options are available for you. Okay. So just wanted to share that with you guys. Hope you got value from this. Have a great day. And again, feel free to reach out to me with any questions. Would love to be a resource for you. I can help you nationwide. Have a great day. Peace.